to create to help spread the word. Because I think, as I'll cover in the next few slides, my first few slides, I really want to really kind of focus first on what we call market health and really point out some of the reasons why we do believe this product. It's not necessarily a product for everybody, designed for everybody. I think that's the overarching story and truth as it relates to any financial product. There shouldn't be any product that's sold or thought as a one size fits all solution. One of the biggest benefits of this product is that it really allows customers to tailor the results of their mortgage journey by the way that they use it, which is wildly different. And again, although we know that it's not really necessarily suitable for everybody, we do firmly believe that everybody should know that this loan that it exists. And like you indicated, it's been around for 16 years. I'm going to go and advance forward on my slide. We'll get going. As a starting place, let me just cover a little bit of the history. This is a privately secured mortgage product that was pioneered by us, CMG Financial. We're one of the largest privately secured mortgage banking firms in the United States. Family owned and operated, about 30 years old. That being privately owned has afforded us what we call a lot of athleticism over time, a lot of agility. I don't think that the words mortgage and innovation tend to go in the same sentence together. There's not been a lot of innovation. And when I say innovation, I'm not talking about relaxed guidelines and credit tolerances or risk tolerances, because those things kind of change. And as lenders try to fill certain gaps or voids that exist out there in the market, to help more consumers, more qualifying consumers with mortgage lending and housing opportunities. But what I'm really referring to is the re-engineering or restructuring of the financial tool itself. Mortgages, the traditional mortgage products that most of us use, are products that were designed and put to market during the Great Depression era, 1938 to be exact. Just very old, archaic tools that we continue to use to finance the American dream. We set forth, and actually in 2002, to change that for a variety of very good reasons. We don't sell this loan off to loan aggregators or to Wall Street. When I say privately secured, I mean that it's a proprietary loan product that we have partnered with several other institutions around America, and to make this product available and bring it to market, which we did in June of 2005. So it's been just nearly 16 years since we released it. It's not a new product, as Danielle said. And we've gone through trials and tribulations with it in terms of market conditions. We've watched the housing crisis of 2008 unfold, the aftermath of that, and kind of the rebuilding out of the Great Recession, to the COVID nightmare and shutdown. This is a loan that continues to perform, reduce risk, help people in ways that traditional loans just simply can't, especially as it relates to their housing costs. It not only provides customers the financing they need to own real estate, whether that's through a purchase or just a refinance, it's available for both, but it's also engineered to help customers repay their debt significantly faster. And the benefit of that is, if you can pay down and pay off your debt faster, you can actually avoid a tremendous amount of interest cost that typically comes with mortgage debt. And of course, everybody is interested in saving time and money. I think we can all agree that nobody, not a single one of us, likes to overpay for things. If you are given the choice to avoid unnecessary or excessive cost in your life, I think that most of us would choose to not overpay for things, so that we can retain, more of our own income and spend that income in better ways than mortgage interest. The real key aspect of the product, though, is that it achieves these things. It achieves cost reduction, time savings, without a required change in monthly budget, no disruption in lifestyle. It also doesn't increase the minimum monthly payment obligation. So we're not increasing the minimum that somebody has to pay out each and every single month. So we're not forcing a required increase in expense. It also achieves these things without having to chase interest rates around. I mean, if you think about it, the conventional wisdom is that when we borrow money for housing, specifically our homes, home prices are high. They've always been high, relatively speaking. And so what we do as consumers to offset some of that cost is we tend to obviously seek out the lowest interest rates possible, but nobody controls or influences the interest rate environment, right? So to offset cost, the only thing we really do is we delay the pay down. We actually borrow for longer periods of time. For the 30-year loan is the gold standard in America. So we really kind of delay the pay down of the debt itself and seek out a low interest rate. Again, rates don't always cooperate with our goals, especially right now. We're sort of in a rising rate environment. Relatively speaking, historically, the interest rates today are still highly competitive. They're still very low compared to where rates, have been over the last 30 years or so. So keep that in mind. But I think one of the most terrific things about this product is that the benefits are provided without having to worry about interest rates. Interest rates could be high, they could be low. And this mortgage product is designed to help people save time and money and live a lot more flexibly. Okay, just as a summary. Here's some food for thought, some things to think about. Here's really our motivation to pioneer a product, 16 years ago. That is wildly different, goes really against the grain or against the status quo in the mortgage lending world. We know that most Americans have to borrow money in order to buy real estate, without question. There's approximately 60 million households across the United States today that are mortgaged. It's a lot of households. And in fact, the vast majority of mortgage debt is owed by Gen Xers and baby boomers. 60% of baby boomers out there still owe a mortgage. Clearly, there's something wrong. Clearly, if it's that difficult to pay down a mortgage debt or your housing debt, maybe that's because the debt instrument itself is too cumbersome, right? We also know that price increases over time are really eroding away affordability, not just with housing, but with affordability in a variety of different ways. It makes it much harder to save for things like retirement security or maybe sending your child to college and funding that without having to go into decades and decades more of debt. We also know that 90% of homeowners who rely on mortgage financing to own real estate depend on a 30-year, they borrow for 30 years. And the typical mortgage borrower doesn't actually pay off their 30-year loan any longer. Even a 15-year loan is something that gets recycled frequently. The average customer, the average homeowner will recycle their mortgage debt about every 5 to 7 years, historically speaking. National mortgage debt is actually approaching about $13 trillion today. So it's just an astronomical amount of money that's owed. And that's just the principal balance that's outstanding. And that doesn't include the interest cost that comes with all of these mortgages. And again, long-term debt tends to erode that savings and wealth building potential. National retirement income is in deficit. So in other words, the amount of money that people have to have saved to retire securely versus what they're on track to have saved is actually widening. That gap is widening. It's estimated to be between about $7 to $14 trillion. So in other words, we think that without question, the mortgage is part of the problem. As it relates to all other money that's spent on other debts at the household level, it doesn't get any greater than the mortgage. It consumes statistically somewhere about 42% of all of those dollars. It's a massive consumption of personal income resources that, at least a portion of that should be utilized to go build wealth with and maybe buy additional real estate with, buy another business or expand your business, send your kids to college again without having to go into debt, pay for financial emergencies like medical emergencies. There's far greater things, more important things to spend money on than mortgage interest. And you could really, I could really boil down the problem with traditional mortgage financing into just one slide. And here it is on screen. All of us understand how these things work. They come with a payment plan. And that's also known as an amortization schedule. When you get a traditional mortgage on your home, such as a 30-year fixed, it's going to define how much your balance is going to reduce by on a monthly basis over the entire 30-year term. It's also going to determine in advance how much interest you're going to be charged over the entire 30-year term. It's also going to define how much of your payment is principal on a monthly basis versus interest cost. And we as customers, we as borrowers, don't get to change that. We don't get to call up our bank, our lender, and say, hey, I'd like my entire payment to go to principal. Can you make that happen? They're not going to do that. You've already got a payment plan in place that you've agreed to as part of your loan documents in the contract. And this amortization schedule is designed not necessarily to benefit us first. If you really think about it, we're paying most of the interest cost up front. They're front loaded with interest. In fact, in the very first 10 years of a 30-year loan, we would be charged 50%, just about 50% of the total interest cost on that product. 50% of the total interest charged and paid by the customers in the first third of the loan. It's just again, a colossal waste of time and resources. Let me give you a quick example mathematically of what that looks like, you guys. I'm just trying to set up really the issue, the problem that we see as a lender. Quite honestly, we think that we have a fiduciary responsibility. It's incumbent upon us as a national established, well-recognized mortgage lender to not only help people obtain financing to buy real estate and own real estate, but we should also help people get out of that debt, get out from underneath it more efficiently, because that sets people up for more success in life. As an example, if I were to buy a home for $625,000, as an example, and put down 20%, so I'm going to finance $500,000 using a 30-year fixed rate mortgage at 3%. Okay, that's otherwise a really good loan, especially compared to current rate levels that have crept up on us in the last 6 months or so. Well, that sounds great, but the problem is that this loan would charge nearly $259,000 of mortgage interest cost. That another way to look at that is that the total interest relative to the amount being borrowed is 52%. Or in other words, for every $100 in principal being borrowed, the bank would be charging $52 in interest. $52 in interest cost for every $100 being borrowed. And that's at 3%. If you're borrowing at 4% or 5% or 5.5%, like some mortgage rates are today, especially in the jumbo and maybe second home and investment property arena on conventional mortgages, that cost is upwards of $80, $90 in interest for every $100 being borrowed. It's not a low amount of money. My point here is that low interest rate mortgages do not necessarily charge low amounts of interest. We still pay high amounts of interest on low rate mortgages. The problem with our mortgages isn't the interest rate. The problem with mortgages is how our money is applied to it. The term, how long you're in debt for, who controls your balance, your principal. Is all of your money going towards principal, or is it a lot of it going towards interest? Are you being delayed? In our view, mortgages delay progress, period. In this example, total payments are roughly $759,000 on a $625,000 purchase price. So day one in this scenario, this customer would commit to increasing the total price of their home by 22% just because of the mortgage. Now, I'm not saying that traditional loans don't have their place. They certainly do. I would argue and probably guarantee that most of you have a traditional mortgage on your homes right now. Statistically, 2/3 of American homeowners owe a mortgage. And again, 90% of them have a standard 30-year loan. About 4 or 5% of our market has just a regular 15-year loan. So, just using stats, most of you, probably at least 2/3 of you, have a traditional mortgage on your house. Our argument is that these aren't necessarily the best tool for everybody. They certainly have their place. Traditional loans were born in the 1930s for people that were clearly struggling to get back on their feet. And so this was developed from HUD and Fannie Mae as a way to standardize the banking industry. It was also believed back then that the average American would work or spend about 30 years in the labor force before being able to retire. And so born was this concept of borrowing over 30 years in this payment plan. And again, it's a good idea for those people who tend to lack residual income, maybe are living a lot closer to paycheck, and are really kind of just getting newly established with their monthly financial behavior. Conversely, we also believe that these loans can be a massive impediment financially, just a big obstruction. They're slow, they're inefficient, they're rigid. You can't take money back out. You can't use your home equity money. You can't miss a payment. You can't alter your payment. You can't do any of those things without getting into trouble potentially pretty quickly. And they're expensive. Again, the average loan will cost customers anywhere from $50 to $80 and higher in interest cost for every $100 being borrowed. Again, these products have not proven to really help people get out of debt without being really cumbersome and difficult. Our solution to all of this is the all-in-one loan. It's a dramatic shift in the way that you think, but not the way you have to behave. That's really the key principle that we set forth in doing when we engineer this product. Let us provide something that just uses money more efficiently, to reduce the debt more rapidly, to help people save money without changing their behavior, without any disrupting their lifestyle, without putting them at risk. And if our customers had more money available, they would probably be more active in real estate. They'd certainly be more secure, financially independent. Probably we wouldn't have this massive mounting retirement income problem that seems to be mounting over time. It's now estimated that about 20 million Americans, newly retired Americans, in the next 15 years will actually live in poverty. It's a sad state of affairs. And many of those people are homeowners who owe a mortgage. The mortgage is part of the problem. So here's how it's structured. The all-in-one loan is a mortgage security. We follow Fannie Mae standards, industry standards. It just happens to be a portfolio or proprietary product that we privately secure. So it provides the financing needed, but instead of being just a structured repayment plan, we instead engineered a first lien position, 30-year draw home equity line of credit. So we go from just a traditional mortgage that's has a fixed payment, and instead we open it up and say, let's make it possible for people to put money in whenever they want and securely keep that money available so they can take it out whenever they want over 30 years. Let's just start there foundationally. If you could put $1 towards your mortgage right now because you happen to have $1 extra today and your balance reduced by $1 today, that then offsets the amount of interest you're going to be charged. What if you have $100 or $1,000 or $10,000 just idly sitting around, right, waiting to be spent tomorrow or next week or next month, next quarter? Maybe it's just your rainy day fund. What if you could apply those dollars towards your biggest expense in life and keep those dollars available for future use securely? But in the interim, it will benefit you by saving interest cost on the mortgage debt in total. So that's the foundation of the all-in-one loan, is a 30-year draw home equity line of credit that can be used to purchase real estate or just refinance from a current mortgage and do this one. The line of credit is structured very uniquely. There is no balloon payment. There's never a structured P&I payment. Whatever the line of credit limit is that we establish and close the loan at, and I'll give you some parameters here in just a moment, guideline limitations. Whatever that amount is, it's established and remains unchanged for the first 10 years. After the 10th year, that credit line limit begins to reduce each and every single month by 1/240th. There's 240 months left in the 20-year ending period of the loan. And so we're going to take the original line amount, divide that by 240 months. And that's the amount of dollars that the line of credit the limit itself will begin to step down every month evenly over a 20-year period of time. And this is how we keep your money liquid. This is how we keep a customer's money liquid. Anything in between the daily principal balance and the line of credit limit is just available equity money securely in the line of credit, available 24/7 for use over the 30-year period of time. I'll go a little bit deeper into detail about how you can use it and things like that here in a moment. Some of the highlights, like I said, there's no balloon payment. There's no prepayment penalty. I still do believe today, to my knowledge, it's still the only 30-year draw home equity line of credit available in the United States. We allow loan amounts or line of credit amounts up to $2 million without any geographic limitations or restrictions like on conventional mortgages. And we make exceptions up to $3 million. And we're actually going to be expanding our guidelines officially up to 3 million in the near term. Again, it can be used as a purchase and also as a refinance. It applies to primary residences, second homes, as well as investment properties. So if you're a real estate investor or you have an investment property, maybe short-term rental property that you earn some income off of, this is a phenomenal way to finance that property and just drive your rental income, your revenue directly into the mortgage to reduce its balance. And I'll show you how easy that is and the additional features that come with a mortgage, because it's more than just a traditional or a standard HELOC. This also applies to single family residences and multi-unit up to 4 units. So 1 to 4 unit properties are allowed on this product. It does require decent credit, good credit score, 700 as a minimum and 720 for investment properties. We can go to 90% loan to value on a purchase or rate and term refi, 80% on a cash out refinance, and 75% for an investment property as a maximum. And again, we align with agency standards, meaning Fannie, Freddie standards for debt to income ratio, reserve requirements, things like that. I would say the one, primary characteristic that a borrower must possess to have a great success with this loan is just that you have to have some good cash flow behavior, live within their means, not a household that is living paycheck to paycheck and is struggling to make ends meet, maybe a heavy user of credit just to supplement their income and lifestyle. This is a product developed for people who live within their means and manage their finances in this established way with some discipline, some level of discipline. Interest rates on this loan are not fixed. This is the paradigm shift. There are 3 things that matter when you borrow money. Only 3. At the end of the day, there's 3 things that equate into the cost of the debt itself. And by the way, it's the same 3 variables at play when you invest money and you hope to grow the value of that money or the value of that asset. The same 3 variables. There's only 3. Interest rate, the term or time, and then the principal balance. Right? If you're trying to grow money, we're all taught, pay yourself first, invest with as much as you possibly can that you can afford as frequently as you can do that for as long as you can do that. Start early in your life, start investing, building up your savings, building up, whatever your retirement funds, start investing sooner, right? So we're taught that time matters and that your principal balance matters. What we do also know about investing money is that the market ebbs and flows. It rises and falls, right? So your yields are going to change over time. But what matters most is the amount of time you stay, committed to investing, as well as building up your principal balance. Conversely, think about managing debt. It's the exact same scenario, just kind of on its head. What matters most isn't the interest rate. What actually matters most is the amount of time you're in debt for and what you're doing with your principal balance. Again, are you dropping it fast or is it going to stay high for a long time? If that's the case, even with your low interest rate mortgage, it's going to cost an arm and a leg in interest cost. You're going to have a significantly higher interest rate loan and pay significantly less interest and spend less time in debt. We chose not to create a fixed amortized mortgage instrument out of this product. Instead, what we chose to do is create a rate structure that is aligned with our own borrowing structure. When banks and lenders borrow money, they're not at fixed rates. They fluctuate over time with the market cycles. What we said is we set out to make a product that allows our customer to really, share that risk and the benefits of rates moving up or down. We do offer a 5-year fixed version. After the 5 years, it becomes a monthly adjustable. We also offer a 3-year fixed option. After the 3 years, it goes into a monthly adjustable. Or we offer just the straight monthly adjustable, 1 month adjustable. So we're not locking in the rate, locking in the payment. And I'll show you the payment structure of this loan here in just a moment. It's very unique, very appealing, much better. If you think about it, what good is a fixed rate and a fixed payment as the cost of living is increasing? As the cost of living increases with inflation, that means there's less and less and less residual money left over each month. So you're being squeezed. Every household in America out there is being squeezed because the price of gas is up, real estate is up, The price for a pound of coffee is up nearly 50% over the last 20 years. I mean, everything around us is rising in cost. So if you have a payment on your mortgage that's fixed over 30 years, you're still being squeezed. What's great about this loan is it provides an opportunity to reduce the amount of mortgage interest or the mortgage costs that a customer has to pay each and every single month. And in fact, reduce it at a faster pace than money is eroding away due to inflation. So it's a phenomenal product to use as a hedge against inflationary pressures and the expense of inflation, but also just simply to live a lot more independently, financially speaking. Most of our customers choose the 1 month option. It's a monthly floater, can move around. The index that we use is called the 1 year constant maturity treasury rate, or the CMT, AKA the 1 year treasury. Its historic average is right around 2%. So very low. That's why we chose it. It's very predictable. Rates are very competitive to conventional mortgages. So just keep that in mind. It's a competitive rate. The interest rate can fluctuate, but due to its entire design, your balance drops significantly faster. That's the opportunity. The key feature on the loan is, and the reason we brand it the all-in-one loan, is because it also comes with a consolidated bank account, a checking account. In other words, we have merged together home financing and personal banking into one instrument, one financial product. And if you really think about it, this makes a tremendous amount of sense. You know, a lot of money flows through your personal checking account. Most Americans will earn more in just 5 years than they owe on their mortgage. And those dollars all typically flow through a primary checking account, right? Where it's a landing place for money. It securely sits there waiting to be spent, earning near 0%. And then we pay our bills slowly out of that, including a traditional mortgage payment, in which is costing us much higher interest, much higher in interest rate, and much higher volume of interest is being charged on our debts than we're being paid on our money. But there's this invisible barrier between the two, right? Between our cash accounts, where we manage our finances from, and our debts, our liabilities. What we said is, gosh, let's break down the barrier. There shouldn't be a barrier. Let's link them together. Let's link the checking account to the mortgage. And let's make the mortgage a two-way instrument, freely allowing people to put money in and take money out whenever they want. But let's make the mortgage the temporary holding place for the cash. And the way people get money into the mortgage is through the checking account, the linked checking account. So it's also known as a zero balance sweep checking account. And now what this means is, if you were to make a deposit into your all-in-one loan checking account that comes with your mortgage, either through a purchase or refinance, your money doesn't reside there. Instead, it's going to sweep and automatically pay down the principal balance of the mortgage. If you deposit $1 today into your all-in-one loan checking account, your principal balance drives down by $1 today. If you put your paycheck into your all-in-one loan checking account, your entire paycheck sweeps that day securely to the mortgage side and pays down the balance to the HELOC. And that's an enormous benefit. Number one, because money's kept liquid and available to use 24/7 through all the banking features. Comes with ATM debit Visa cards, online banking, bill pay, mobile banking. You could do mobile deposits through the mobile app. You could link external accounts to the all-in-one loan checking account, transfer money in and out without fees. You could wire money anywhere. You can use this globally. It's a highly secured, FDIC insured checking account, serviced by one of our great bank partners across the United States. But again, the mortgage is meant to be the holding place for your money. And that's a benefit because of the way interest is computed and because of the amount of time that money tends to loiter around before it's spent. If you think about how we spend money as consumers, we don't spend, all of our money that we need, on one day for the month. You don't buy all your groceries for the month of May on May 1st. That's a weekly expenditure. We also have one-time expenditures like a utility bill or a cell phone bill. The mortgage, the traditional mortgage payment, is a one-time a month payment, right? So money kind of resides in your accounts waiting to be spent, earning 0%. Quarterly expenses, semi-annual expenses, and some annual expenses like income taxes. As money's waiting to be spent on these things or not spent at all, instead of leaving cash in a cash account where it's losing buying power due to inflation and earning 0% or near 0%, the average rate of return for a checking account in the United States today is a mere 0.03%, 0.03%. But again, people will earn and manage more money in their checking account in just 5 years than they own their mortgage. Bolting these two together makes a lot of sense. It's very practical, very easy. Interest on this loan is not amortized. It's not predetermined. Instead, we're going to recompute interest nightly, every single day at midnight, specifically midnight, Eastern Standard Time. Interest is computed. It's simple interest, not compounded, and it's not amortized. Whatever's owed on the HELOC times the rate divided by 365 is that day's interest expense. Now, our customers aren't charged that interest daily. It's just recomputing nightly in the system. And at the end of the month, each day's interest is totaled up, and that becomes the interest that's due for the month. But even then, that interest payment isn't due until the 21st of the new month. So in real terms, all of our all-in-one loan customers today, their May interest payment, which equals 31 days of cumulative interest for the month of May, that's not due until June 21st. And where it'll be automatically drafted out of their HELOC, out of their all-in-one loan line of credit automatically without them having to lift a finger. It's extremely hard to go late on this loan because your payments are automatic. It's just the interest only. You get to control your principal. You want it to be high, you want it to be low, you want to speed up the process. You want to use cash savings that's in an account earning 0.5% to help offset your mortgage balance and save you 4.5%. I mean, it allows you to use your money more efficiently without losing access to it. So it's a very safe way to reduce, exposure to unnecessary costs that typically comes with a mortgage. Again, money kept liquid 24/7 through all the banking features. I'm going to run through a quick example, and believe it or not, we're almost done here with the information, and we're going to open it up to questions. But let me run through a quick example. I'm going to use the same numbers and compare our loan, the all-in-one loan, to a traditional mortgage, a 30-year fixed that somebody's had for 8 months, and they're at 3%. We're going to finance $500,000. Now, if you think about it with a traditional loan scenario, it doesn't matter what you make in income. After you have your loan in place, your income, your biggest source of money and volume of money throughout your working life, that doesn't matter. It's not being facilitated. It's not being used at all by the mortgage. It's in a separate account, earning very little, right? If anything at all. In our loan, income matters. What's driving through the checking account? What's that behavior look like? Is there any money idly sitting today waiting to be spent this coming weekend? Oh yeah, the average American household has a ton of money sitting around waiting to be spent on things that they have to spend it on over the next few weeks and months and years. So let's put the money to work. In this scenario, I have $150,000 on an annualized basis as an example, and about 75% of that routinely being spent out annually as well. This is a typical all-in-one loan scenario. I'm going to walk you through the first 90 days very rapidly here. But just conceptually, you start with a beginning loan balance. When we close the loan, the banking welcome kit is received by our customers about 2 to 3 weeks after we close the loan. That includes ATM, debit, Visa cards, your temporary passwords to go online and log in to your banking portal. It's a consolidated banking portal where it shows you the checking account and the line of credit combined. And so you can see the money movement, money deposited, money transferred over, balance reduced, all on the same day. Money left available for expense spending, right? So your expense spending goes out of the account. You can log in to the app or through the online, your desktop version anytime you want to see this stuff. Bill payment, writing checks, whatever and however bills are paid in your life. You will naturally, our customers naturally, typically will end the month at a lower balance, finishing balance than they began with earlier in the month. And that's just leftover money is home equity money. So this loan drives down the balance naturally faster, building equity in the property at an accelerated pace. The reason why this occurs, the money that's left over includes not just the amount of money that you might not have needed to spend this month, right? But also the money that was normally budgeted for a traditional mortgage payment. If you, as an example, have a $2,000 a month P&I 30-year fixed mortgage payment, which is part of your income, you had to earn those dollars. And before you make that mortgage payment, those dollars hit your checking account. And instead of doing it that way, what if we refinanced you and said, let's consolidate the two accounts together, give you a more efficient financial tool. So you deposited your paycheck directly into your all-in-one loan. Well, you effectively are now using what you used to spend on a mortgage payment to drive down your principal balance by $2,000 and the rest of your paycheck the day you make that deposit. And from there, if you were used to spending the money on a mortgage, you should be as comfortable keeping the money with you in the HELOC. If you do that every single month, that compounds. That compounds the savings, compounds the equity acceleration or gain in the property. Month number 2, another deposit on screen here as an example. Periodical spending. There's the interest payment on the 21st of during month number 2 to pay for cumulative daily interest from month number 1. Just automatically drafted out of the line of credit. Statements are cut on the 1st. So our customers see exactly how much interest is going to be drafted from the line of credit on the 21st of that new month. If you think about it, this is interest paid for in arrears, principal paid first. This is the only, to my knowledge, still the only principal paid first mortgage in America. Not even a traditional HELOC does that. It doesn't matter how much or on what day or to what routine money is deposited into the accompanying checking account. All of that money is transferred to the HELOC and pays down principal, regardless of when that's done, all the time. That keeps even the money that is needed to pay the interest payments in the line of credit for an additional 20 days before it's drafted out. Again, we are ending the balance at a lower place than where it started, building equity faster in the property. This continues to compound. Deposit, expenses, interest payment for month number 2, done on the 21st during month number 3. Ended with a lower balance and continuing to compound equity gain in the property. It's dramatic and very gratifying. Here's the results of this example. Would you rather be in debt for 360 months, or in this example, 352 remaining months on that 30-year fixed at 3%? Or would you rather have your mortgage paid off in 127 months or 10.6 years? Our average trajectory for all-in-one loan customers is in the neighborhood of about 8 to 10 years for payoff. I know people that have paid off their house in 4 years. They were astonished by it, just because it accelerates the principal reduction. And then turn around and use those dollars. Think of all the ways you can use this loan. You can pay down faster. You're liquid. Use it to go fund college education for a child without having to go get a loan. Buy a VRBO property. Go buy multiple VRBO properties. Go take advantage of the real estate market. Pay for medical emergencies that are unplanned or planned. Just a tremendous amount of things. Retire, live more securely. The average American household out there that is approaching retirement ages doesn't want to necessarily downsize. They would live a lot more independently and securely, probably be much more active in real estate and improving their own home if they simply have less debt, less housing debt, and had access to their equity money. They can manage it better. And that's the whole point of the product. Last slide, and then we're going to open it up for questions. I would like to point out not only Danielle's wonderful team that is, available to help answer questions and run you through you or somebody our interactive comparison simulator, which can be found on our public website, and that is allinOneLoan.com. Just simply www.allinOneLoan.com. We have an interactive calculator that just compares the all-in-one loan to a traditional mortgage. It also has other information on it, customer testimonials, a brochure, FAQs, a tremendous amount of resources, but most certainly depend on Danielle and her team to run scenarios for you and answer any questions. And I can also be available to help as well. With that, this was meant to be very high level and not really take up your entire day. And so, this is my last slide. I'd like to, stop here and open it up for any questions that you may have. And feel free to enter those into the chat box. And then Danielle and I can answer those.
Yeah, I want to make a couple of points. And then Jessica's been taking some notes as well for any questions. But one of the things, and you just kind of said it at the end, that I'm really trying to explain to people, especially business owners, real estate agents, investors, is that if you take out a traditional mortgage, you're not able, and you pay it down. Let's say you pay $50,000 down on the principal balance, which would take you a long time to do, but let's just say you do that. You cannot access that money unless you refinance or take out a second mortgage, which would be a line of credit or a second mortgage. Where with this product, you can really use the funds to grow and scale your business. Because a lot of times businesses need money for marketing, for overhead, for more products, maybe they buying another investment property. And this is a really great tool to use on your home, whether it's a primary, second, or investment property, but then be able to tap into that equity to use that to make more money. And I think that's one of the, key features of this product. A lot of people get into it because, yeah, they want to pay their home off in record time, which will also free up more money as well. But sometimes I'll talk to people about doing a refinance and they'll say, you know what, I'll say we can go 80% loan to value based on whatever the value is. Oh, I don't want to do that. I only want to pay off what I currently have. My goal is to pay it down quickly. Well, the good thing is that you're not paying the interest on the total line if you don't take that full amount out. So it makes sense to do the 80%. So that way you have access to, God forbid something happens, you need emergency funds. Or all of a sudden, your child is going to a more expensive college or whatever the case may be. So that being able to tap into the equity is a huge benefit of this mortgage, and you're gaining equity a lot quicker because you're able to pay off the mortgage a lot quicker.
And let me add this too real quick, Danielle, on that note, there another great feature, especially for the home buyer out there with maybe more than the minimum down payment amount. Oftentimes people are willing and want to come in and reduce their initial a debt size on a traditional loan. And I've seen this where, they're contemplating coming in with, let's just say 30% as an example, down payment on something where, to your point, we could qualify that same home buyer to an 80% level line of credit, all in one loan line of credit. They can still come in with their 30%. But in our situation, we are going to keep liquid a portion, right, 10% of their down payment available to them to tap into or use down the road if they want to or need to. So we're going to keep it liquid. And I think it's really appealing to some of those folks. We can also use this, obviously, for delayed financing. Cash buyer comes in and, wins a contract and closes on that home. The day after that, we can take the loan application, do a cash out refinance without any seasoning requirement to where they can obtain, back up to 80% typically the money they came in cash with to buy that property. So a variety of different features, an asset depletion feature where we can just use assets to help qualify, and that's really going to help out with business owners.
That's huge.
Where maybe their tax returns, is. Maybe there's a little bit more complex situation where the way they, structure their tax liability to help reduce it. This is a phenomenal way to say, hold on a minute, maybe we don't even need your tax returns. Maybe we don't even have to run IRS transcripts. Let's just take a look at your assets and see if we can't use our asset depletion feature, which is our methodology is pretty aggressive, but in line with industry standards, and essentially help somebody qualify without having to go through, the rigmarole of qualifying using their tax return. So a lot of nice features for business owners, self-employed, of course, the real estate, investors, anybody that's looking to buy, or simply, frankly, people that already have a mortgage, that otherwise think that they're sitting in a really good place. And take a look at the total bottom line. How much interest are you being charged, and are you committed to already? And how is that impacting your wealth potential?
Right.
By and large, statistically, it impacts it immensely.
And I can personally, we've had somebody self-employed. A lot of people write stuff off, or write a lot of things off on their taxes, and they would not have qualified for a conventional loan, but they had enough assets. So I was able to do an asset depletion. And in fact, the all-in-one loan was the only loan they qualified for. Good thing they wanted the all-in-one loan, but that really was the only loan that they would qualify for based on the asset depletion and the way that we were able to do that. One thing I also want to mention on the flip side, and conversely, what you were talking about, if somebody is a cash buyer and delayed financing, a lot of times I'll have somebody that says, you know what, I really don't want a mortgage, but in order for me to buy something, I need to sell my house first. Well, my house is not going to be sold by the time I buy the next one. However, my plan is when I sell my current home, I can buy the next one, not have to move out yet. Then when I sell that one, put it down on the line so they actually have no mortgage afterwards, but still have access to the equity and they're not paying interest on it.
Yeah. Yeah, absolutely. You don't have to close this. It doesn't close automatically. Imagine reaching zero on your balance and having access to equity money over 30 years without having to refinance again. Think of the variety of things that you could utilize this for. I mean, I like to always say there's no required shift in behavior or budget, but certainly it does sort of change the way you think about mortgages and money, and how other people tend to use or benefit from our money more so than we get to benefit from our own money. This changes that. People get to actually act as the bank of themselves, right? They actually get to really function as the banks do.
Right. Exactly. So another question I get a lot is, and you kind of answered it, but I just want to, make sure everybody understands it, is they'll say, well, what's my monthly mortgage payment? And to that extent, I say there really isn't a monthly mortgage payment. It's the interest payment, which is going to be different depending on your cash flow for that particular month. So can you touch on that a little bit?
Yeah. So in the traditional sense of making a payment, we all know how it works. We send away a monthly amount, whether it's for a car loan, a mortgage, a student loan. I mean, most loans in America are structured this way, where we're sending away a lump sum of money. But within that lump sum of money is part interest and part principal, right? It's sort of hidden how much of your money is going towards each month. And that's the downside. we're not engaging the debt and engaging the amount or control of it with how much is going to each of those, right? To repay the debt that you've borrowed, the money you've borrowed, or to pay the interest on the borrowed funds. We don't control that, and it's somewhat hidden. The greatest thing about the all-in-one loan is that we separate the P from the I. The principal that you owe, that a customer owes, the repayment of that principal is simply done by making deposits. You make a deposit, bam, it's a principal reduction payment that day. But that principal reduction payment, by whatever amount you just did it with, remains liquid. So it makes it feel very comfortable and safe, because a lot of people go, gosh, if I I do have extra money at the end of the month, and I don't spend all my money on just one day throughout the month. So would it be nice if I had a checking account that just, applied it to the debt automatically and allowed me to pay my bills directly from it? So I'm saving interest even on the money I have to spend. But think of deposits as the principal repayment. Anything you leave in the line of credit resides there as principal reduction. It already goes to principal, kept liquid, but goes to repaying the debt. The interest payments are a separate event. And what happens is the interest is being computed nightly at midnight, every single day. Whatever you happen to owe today on my own loan, whatever I happen to owe today, tonight at midnight, times my interest rate divided by 365 days is today's interest expense. I'm not charged that daily. It's just recomputing, behind the scenes in the system automatically. Tomorrow, if I get paid, my balance goes down. It reduces that, tomorrow's interest costs. This occurs every single day. And at the end of the month, that's going to total up for the month of May, 31 days in May, 31 days of cumulative interest, $18 here, $18.10 there, maybe $19 that next day. Maybe it dropped after deposit down to $15 that day. The total, amount of interest from each day is summed up, and that becomes my interest payment. And that's simply drafted from my all-in-one loan line of credit on the 21st of the next month of each new month. So interest paid for on a separate day than how you pay down principal. Deposits pay principal. The minimum payment obligation on this loan is just the interest, and that's an automated interest payment, right? So that you don't have to worry about it.
Which will bring me to my next point, because there are a lot of business owners, and real estate agents or anybody basically on straight commission, where businesses ebb and flow. Like, you don't know, okay, every month I'm going to make this amount of money. So if you have a couple of great months, but then, followed by, let's just say 3 or 4 months, or maybe you have stable income, but you lose your job and you're out of work for a couple of months, right? As long as you have equity, whatever your balance is to whatever the line amount is that you took out, you don't have to make a payment, right? That interest is going to add up, but you're not going to get a 30-day late on your credit report, right? You're not going to have, be risking foreclosure with this particular product, where if you're in a traditional mortgage and you have a couple of really bad months or lose, God forbid, your job and don't make a mortgage payment for 6 months, well, you're possibly heading into foreclosure or forced to sell your home. Where with this product, not that you want to use it for that, but it also gives you that safety net as well.
Yeah. We've had plenty of stories, honestly. I mean, we've had, again, you opened up with this, we've had the loans out since 2005. So we went through the 2008 financial crisis. And I can tell you that we received letters from people, correspondence inbound. I can remember one such correspondence in which the president of our company, our founder, read the letter to a lot of us just over a teleconference meeting, and it was just really emotional. It was just an emotional story about a couple who actually it was one of the husband, I believe, had passed from cancer. And his wife was, they had 4 kids, and they were just, she wasn't in the workforce. She wasn't working, hadn't worked. She was a mom full time, but she was able to not have to worry about her house. She didn't lose her house. They had enough equity in our loan in place where she was able to just get through that, begin to, enter the labor force and begin to generate income without worrying about, potentially losing their house or being foreclosed on. These things happen. I think if there's one thing constant in life, it's that, life throws us curveballs, right? The one thing that is consistent is that life is inconsistent, and there's going to be some financial challenges that come our way, maybe next month, maybe in 6 months, maybe next year. And we've got to change directions. The maneuverability with this product, without having to refinance and having the money securely there available for you, I think is, really the biggest attribute.
Well, which is actually going to just bring me to my next point, and they kind of go together. I got this question today, and the question was, this sounds like too good to be true. What's in it for the bank? Sure.
We get that a lot. It's all about risk and reducing risk and creating a stickier relationship. One of the biggest I think benefits to us is that the credit quality, the kind of financial quality or financial behavior of the customer that tends to gravitate to this loan and get it and they understand it and they use it effectively. Clearly we do a lot. We put a lot of effort forth to coach and educate and really reach the right amount, the right people for the right reasons with this product. We're not interested in trying to sell this as a one size fits all solution. It's not, but it's an extremely dynamic and powerful tool for those people who are cash flow positive and have some financial discipline but want to maneuver through life using this tool can provide a lot. It also creates a stickier relationship for us. If we were to make, somebody a 30-year fixed and just apply statistics to that customer and to that loan, chances are we'll lose that customer in 5 years. They'll find a reason to refinance their mortgage or sell their home. There's going to be a reason in most cases that people change their mortgage about every 5 years historically. And lenders, as you know, Danielle, spend a lot of money and a lot of time trying to retain customers. Customer retention is extremely expensive and cumbersome. Or we spend a lot of resources replacing customers that we lose because of this vicious cycle, this endless cycle of, recycling mortgage debt for whatever the reasons. If instead we just developed a mortgage product that you are a whole lot less likely to need to get out of or want to get out of because it creates all this flexibility and control over an extended period of time, guess what? We tend to not lose customers as frequently as we would with a traditional loan when we supply them the all-in-one. In fact, we actually have the opposite. People refer or want additional all-in-one loans on additional properties, which we can supply, by the way. We can do more than just one per borrower. So, what's in it for us is that it reduces risk. It's extremely hard to go late and default on this product. So it reduces risk to us, and it creates a better relationship, a stickier relationship with customers. It's just that simple.
Yeah, exactly. And I think, a couple of points on that. First of all, when you get a mortgage, and as you said, most people are paying it off every 5 to 7 years. The banks know that, right? So the first 5 years to 7 years of your loan, you're paying almost all interest. Very little is going towards your principal because they expect for you to be, refinancing or selling or paying off your loan in about 5 to 7 years. Where with this particular product, you never have to, unless you're selling the home, you never have to really refinance again. I mean, this creates a long-term product for the bank, because for most people, the only reason they're going to pay off their mortgage, aside from a purchase, is either to refinance, to get cash out, or reduce their interest rate. And if they're reducing the interest rate, it's because they want to obviously pay less interest in hopes to pay off their home a lot sooner. If they're getting cash out, it's to, do whatever, put in a pool, buy investment properties. So with this loan, it does both of those things, which are the two main things why people refinance anyways. So,
and you just answered the question, Danielle. I think that a lot of times people want to also know, as a follow-up, if this is so great, why aren't other lenders and other banks, and why isn't this mainstream? Why isn't everybody out there offering it? Well, you just answered that question. It's literally less profitable. I mean, we don't have a guaranteed rate of interest income. And we could supply this loan to somebody and they pay to zero in 2 months, but that's the benefit of the loan. Chances are they're going to want to leverage their money and go do something with that downstream, or maybe not. That's fine. But that's the reason why most lenders and banks aren't going to want to offer something like this. There's less of a guarantee of interest income to them. For banks specifically, most banks don't want to offer this because they want your money to reside in their checking accounts so that they can leverage those dollars and borrow against them to make more loans. Well, in the all-in-one loan environment, your money doesn't reside in the checking account. So, from their perspective, it would cannibalize, their business model in a sense. This actually is a physical sweep of your money, digitally, securely transferred out of the checking account, instantly over to the HELOC to pay down the principal balance, all visible to you online and through the app. And so it removes the benefit, the leverage that banks get and gain and rely on by us leaving our money idly sitting in our checking accounts, even if for a day that they're leveraging our money. This takes that leverage away from them. That's why they're not interested in offering the product. I mean, so, sometimes there's good guys out there, good guys and gals that generate, innovation and really believe that what's good for the customer is good for us. And this is one of those cases.
Absolutely. So last and final question, and I think I've said that a couple of questions ago. Do we have any others, or is this?
It's just someone put in there, they didn't see any flyers or your information.
Okay, I'll send the flyers and information on that out afterwards. But last and final question is, one of the questions I do get asked is, does it cost to sweep? A lot of times the sweep account, there's a cost every time it sweeps, and they get nervous, like, oh, the sweeps every day, that's going to be a lot. Sure. Well, that would not make sense. So there isn't any cost when it sweeps over. No. What are the typical costs?
Yeah, I mean, so as a line of credit, there is an annual fee. It's a whopping $60. There are some states where there's no charge or less of that charge. At the most, it's $60. So it's a $60 annual fee, and that's waived the first year. Why is there an annual fee? Because we don't charge. We typically actually reimburse any out of network or third party ATM transactions. So if you were to use your your all-in-one loan ATM debit Visa card to pull some cash out, say you go to 7-Eleven, and the network owner of that ATM machine is going to ding you $5, and you say, yes, I need this money, so I'm going to pay $5 to get out my 20. Well, that $5 surcharge fee is going to get reimbursed to you automatically each month. And so, and believe it or not, we feel very passionate about that. We think that this should be an account that is not rich of fees. That's not what we're trying to structure here. What we structured is a mortgage security to help people get out of the debt faster and live more flexibly and independently, not to make us rich off these little nickel and dime fees. So we're going to reimburse those surcharges back. The annual fee is a little bit of recoupment, a small portion of that recoupment annually for the transactional use to basically service the mortgage product and checking account combination over 30 years. So other than that, if there's any other third-party fees that are related to using the account, those are typically, again, reimbursed. No fees for the sweep whatsoever. And in fact, I would argue that you're without a mortgage that sweeps, or without a checking account and mortgage that sweeps and uses your money to reduce your debt, you're already paying higher interest than you need to. you're already being charged a fee for not having a sweep function. Our loan provides the sweep function to help you save mortgage interest at the rate of the loan itself. Let that sink in. Do I put my paycheck over here and earn 0, or do I put my paycheck over here and save 4.5% or 4%? I'd rather go save more money than I could earn over here, right, with the same dollars. So, but no transactional fees, no fees for sweeping whatsoever.
Perfect. So that's pretty much it. I mean, we really covered everything. I will be sending out the recording of this. I know a lot of people were looking to get on. I don't know if something happened with the Zoom link, but I will send that out to everybody and my information as well. I really appreciate all of the information. Like I said in the beginning, I personally have this. I just refinanced a couple of months ago on the product. We had a lot of money just idly sitting in other accounts, a couple of different checking accounts. So it's really helping save, and pay this down so much quicker, with having the flexibility to be able to use it for other investments and things like that. So I think it's a phenomenal product. I do remember it back in 2005. And then, I kind of forgot about it for a little while in the craziness of the market, but I'm so excited to have it back. And, it's not, like you said, for everybody, but the people that it is right for and the people that get it are just like, oh my gosh, I want this product. So. And
the calculator is a big part of that suitability test. We just do not provide this product unless there's an enormous financial benefit. Yes. Period. We don't necessarily position it as just a HELOC to go leverage and take on more debt. Instead, we want to see people, methodically reduce that debt at an accelerated pace. And it does that for our customers automatically. And so the calculator on the website is the best way to stress test financial benefit compared to a traditional mortgage. And we just don't do it unless there's a benefit.
Yeah, and I have that on my YouTube channel. So I have a ton of videos on my YouTube channel. I just walked through a simulator and videoed, myself. So there is a video on the simulator on the YouTube channel, because I do have to point out that two of the biggest pieces of the simulator is how much cash flow is flowing through that checking account each month and how much is left over. And so those are the two pieces that are really important that you know the answer to in order for you to have an accurate reading on that simulator. So I did walk through a purchase, and I'm going to do one on a refi as well. So
great. That's super. Thanks for having me, Danielle. I really appreciate it.
Yes. Thank you so much. Bye, everybody. I'll get the replay out to you. Thank you.
Bye now.